So on the surface, all of this starts with the original banking crisis, which I'll do my best to break down in under a minute, because as it stands right now, the banking system operates on what's called fractional reserve banking. This means that banks are only required to keep 10% of customer deposits accessible for withdrawal at all times. And if that sounds confusing, imagine it like this. You give me $1,000 to hold on to for safekeeping, but I could turn around and give $900 of that to somebody else, who gives $810 to somebody else, who gives $729 to somebody else. Under this situation, banks hope that enough people give them $1,000 so that when the first person wants their $1,000 back in its entirety, they have the money on hand to be able to return. The benefit here is that this allows people like you and I greater access to borrowing capital. It allows us to earn interest on our deposits. But it also relies on us having faith that the entire system works, and also not asking for all of our money back at the exact same time. Of course, to be fair, in most cases, banks are not taking your money and lending it to banks who lend it to banks who lend it to banks, but instead, they loan a small portion of that money out to other people, and then they invest the rest of it in very safe and stable assets. This ensures that as long as those investments are held to maturity, the bank gets a guaranteed return on their capital, you get paid back interest, and everything works swimmingly. Until it doesn't. For example, between 2020 and 2022, interest rates were held at 0% as a way for the economy to grow during a time when everything was shut down, and all of that money funneled back into the banking industry.